A 7% yield looks great until it gets cut. And then you're left with lower income and a shrinking portfolio. Let's see what Dapper Dividends has to say about that.
Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk. Dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time. Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement.
Dividend growth investors, bonjour, Vero here, and you're listening to the Dividend Guy blog podcast. I'm very happy to welcome a new guest today, Russ from Dapper Dividends. Mike has chatted with him before, but it's my first time, so I'm eager to learn more about him. And Russ also wants to help investors avoid dividend yield traps. As the new year is just around the corner, I thought this would be the perfect topic for us today. I can't wait to dive and see his perspective on that. Russ, thank you so much for accepting the invite. How are you today?
Fantastic. Bonjour. Thank you so very much for having me on this wonderful. I've been listening to Mike and the Dividend Guy blog podcast for a long time. So I'm just thrilled to be here. And I got to
Thank
add
you.
this. I know English is not your first language. So I know only a very little bit of French. And here we go. À tout le monde, à tous mes amis, je vous aime, je dois partir. That's from Megadeth. Megadeth taught me that in the 1990s. So I don't remember what it means,
Wow.
and that's
It
all I know.
means to everyone, to all my friends, I love you all, but I gotta go. Basically, this is what it means.
Yeah, that's a little sad, but like I said, not my lyrics, but hey, there you go. So
But I appreciate. I mean, your French is really good, by the way. No big mistakes here. Okay, so Russ, before we dive into our main topic, maybe you could give our listeners the quick version of your story. Like, how did you get to dividend investing? What does your portfolio look like today?
sure. So I have no financial background, and I have a grandfather that liked investing, and he would do it a little bit and talk to me a little bit about investing. And I just remember him saying he owned things like Walmart and Disney and AT&T, which were good dividend paying companies. And really, that's it. They also told me to save 10% of my income. That was it. They didn't teach me where to put it or how to think about investing or anything like that. So I spent all my teenage years, 20s, and most of my 30s not saving, not investing individually. My work does it
Mm.
through a 401k here in the United States, they call it, through the employer, but I didn't do more than 2-3% most years. So a lot of years wasted. And then one
Mm.
day something struck me that I wanted to learn to invest. And I learned penny stocks and tried that, did horrible. Tried swing trading, did horrible. And then and then it was while I was swing trading that I found dividend stocks. I think it was Merck was the first one that paid me a dividend. And I remember seeing it like, wow, what is this? It's a dividend, just money for doing
Right,
nothing. And
right.
then I hit me like a brick on the head. I realized that if I just hold and do nothing, it's a way to get income. And I was really bad at swing trading because I held things too long. So with dividend investing, that's actually a benefit to hold
Mhm.
things for a long time. So that kind of started the ball rolling. And then 2020, when everybody was home, I started a YouTube channel and started sharing what I'm learning and evolving. So that's kind of the short of that. What the portfolio looks like today. So about 45% of it, of my investment portfolio, is just in the S&P 500, which is a
Mhm.
lot. 81% of our investment portfolio, and I say our because my wife and mine, is about funds, is mutual funds or ETFs of varying different kinds. So I want 85% funds and 15% individual stocks, which some people
Mm.
might say looks a little bit high. But there was a study that showed that over a 20-year period, professional fund managers, people that have teams of employees and all the latest gadgets and Bloomberg terminals and things, 94% of them could not beat their indexes, the indices that they track over a 20-year period. So that made me think, I probably don't have a good possibility of doing that. So I hope to one day, but as I'm learning, I still love individual stocks. I love looking at companies, reading annual reports, and things like that.
Mm,
So I am trying to work my way to a better balance, or I don't know, better, but just more individual stocks one day as I learn and become more confident in what I'm doing.
right. Well, I guess it's more about understanding what you invest in rather than, like it's not bad to keep those funds in your portfolio and while you're learning more, just like individual stocks. It took me, I'll be honest with you, Mike has talked to me about dividend growth stocks for like 10 years before I've decided to take the lead and do it myself. So I can get the confidence part for sure. Okay, so let's start with the obvious question. What exactly is a dividend trap in your view?
Yeah, a dividend trap, I think, is a company that has a high dividend yield because it's struggling. Most good companies don't have really high yields because they're doing very well and the stock price keeps going up. So I like to say around here, when the stock goes up, the dividend yield usually drops, and vice versa. When the stock drops, the
Hmm.
dividend yield pops and pushes that yield higher. So that to me is a dividend yield trap where it's like an accidentally high yield, and it can work both ways with an accidentally high yield. Some companies, because the whole market pulled back, may have a higher than normal yield, and that could be accidentally high. Nothing changed with the company, it's just
Hmm.
the whole stock market sold off, and that's a great time to take advantage of. But some companies, you might earn a good yield now, but you'll lose a lot more when that stock crashes and the dividend gets cut, like we've seen with a lot of companies that have done that. So to me, a dividend trap is exactly that. Yield goes high. The stock yield looks attractive. People want to make more money, but it's because the company is struggling and the market is saying, like,
Right.
we don't buy this. And if you want to invest in this company and get that yield, you're going to have to take on more risk. So, very simplistic explanation.
Yeah, well, I mean, it's simple mechanics. It's the mechanics of dividends, but unfortunately, a lot of people don't get it. I'm glad that you put it like simple like that is going to make things easier for a lot of people. I hope so. I really hope. So, Russ, why do you think investors are so drawn to high yield? Like, what makes it so attractive to
Yeah. They don't want to get rich slowly. I am a huge fan of Warren Buffett, and that was why one of his biggest answers is why people said, "What is it about what you do that most people can't?" And he says they don't want to get rich slowly. And hey, I've experienced it too. It
them?
sometimes it's really boring and you see high flying companies and stocks and you don't want to get rich slowly. Warren Buffett has a fantastic quote where he says the stock market transfers money from the impatient to the patient. And yes, it
Right.
also helps living a really long life. But that's just one of the biggest things that I always try and fight is that urge to get rich quick and seeing everybody else making these
Hmm.
crazy 100% gains in 6 months or something on some crypto stock or something. And it's hard to look at that and then see a dividend
It
stock slow growing, but I'll
is.
pull out one. Johnson and Johnson is near $200 today, which is an all-time high as we're recording this, and it's been a boring company. It's been a boring
Hmm.
ride, but it just keeps going higher and higher over a long enough period of time. So, for those of you listening, I always say, when in doubt, zoom out. It's easy to focus on right now today, but sometimes if you zoom out, you can get a better picture of what's going on.
Right. Good advice. Could you share a stock you bought purely for the yield and you later regretted?
Oh yeah, AT&T. That's a popular one that a lot of dividend investors bought.
Classic.
Yeah, everybody was talking about AT&T when I first got in 2018, 2019. It was one of the companies to own. It had a higher dividend yield, so I bought it for that yield. But as I owned the company and got familiar with the business, cuz that's what it is when we buy a stock, you are actually owning a company. And I learned that AT&T, like Verizon, is very
Mhm.
capital intensive. They have to spend all the time a lot of money. It's a very highly competitive business that they're in, and they're loaded with debt. So, I thought great yield, great investment, and man, I was wrong. And since those first shares I bought, AT&T is up about 53% over almost 7 years, and you might think, "Wow, that's really good." But the boring S&P 500, yes, which has been driven and helped by all the Mag 7 and the tech stocks, but it
Mhm.
counts. that's up 156% since those first shares. And that's with dividends reinvested. So,
Right.
it's just chasing that yield. And I could have had more money by just the S&P 500. And I know a lot of income investors. My friend over in Europe from the Dividend Talk podcast, he loves it. He
Mhm.
says the total return police, he calls them. People will get on you about, focusing just on income and not total return. But that's
Right.
something I'm struggling with, just to be, open with everybody, because total return sometimes, as I'm zooming out, looks like more money. And, it's like, well, would I rather have more money or have higher income right now? So I
Mhm.
don't know the answer to that yet. I'm still working on it. So
Yeah, I guess it's about finding our own balance and what we're comfortable with, but for sure, we got to be aware of those eye yields. So, Russ, what were the warning signs about AT&T you missed at the time?
So I'll expand this a little bit broader just to encompass many stocks, but it did include a lot of these. So the sales were declining. That's one of the big red flags I look for. Companies need money coming in the door. If their sales are declining, the money coming in the door, it's going to make it very hard for management to work their magic and grow the business. So sales declining, the earnings per share was also declining, their free cash flow, which is very important. That's the lifeblood of the business. With the free cash flow, companies can pay a dividend, they can buy back shares, they can carry that as cash on the balance sheet. They can
Mhm.
also do things like mergers and acquisitions. So it's the money that's left over after running the business. It's very critical for a company to have free cash flow. And I love it. I love free cash flow. So that was declining. Their debt was going up. So the debt was rising. Debt is a very real thing. A company cannot go bankrupt. You would have to have a very, very talented management team to be able to declare bankruptcy with no debt. So companies that don't have any debt are in a good financial position, and their dividend raises were very, very small, tiny dividend raises. Some people call them token dividend raises, but I looked past all of that because I wanted the higher yield, and I justified the higher yield just to get it, and that was my own mistake. That's a mental thing that we all have to work on, that I'm still working on, is trying
Right.
to justify. Yeah.
I think that's the key point is to just bring with the justifying part. Mike always says that we need to put numbers above the story, like the investment story that we keep telling ourselves. So when the numbers don't match the story, it's time to let go. And I think this is what you just explained. Like you were trying to make up stories for what was happening, but really the numbers weren't there, right?
Yeah, that's a that and that goes beyond investing too, is that a lot of
Mhm.
times human beings, we will emotionally want something and then we will rationally justify it. So we're like, "Oh, I really really want that." And then you're like, "Well, let me think about it." And then your brain says like, "Okay, here's all the reasons I can come up with what supports why you should want that." And sometimes if we're emotional about something, we're not thinking rationally, and we can be open to manipulation, including manipulating ourselves, is something I've found.
Right. So, what would be your non-negotiables when evaluating dividend
A
safety?
free cash flow payout ratio under 70%. Companies need that money to be able to, again, like I said, do those things like merge with other companies or acquire other businesses, just reinvest into the business. Do so. Free cash flow is the lifeblood. And if a company has a very high free cash flow payout ratio, then it means that money is coming from debt or savings to pay the dividend, which that's a big, huge red flag. So 70% of free cash flow payout ratio, with a few examples or exceptions, is something I look for. Is It has to be lower than that. The free cash flow should be growing. I mean, that's one of my non-negotiables. Need that free cash flow growing, or at the worst case scenario is flat. Warren Buffett and Charlie Munger also used to not shy away from companies that had flat sales and flat free cash flow. They were just throwing off lots
Mhm.
of cash. So it can be okay. But yeah, again, just the dividends come from free cash flow and not from earnings, because earnings is just an accounting entry. You can't go to the store and buy things with earnings per share. You have to use free cash. So yeah, and
Right.
and then when a big non-negotiable is when the free cash flow ratio hits 100%, dude, that is a massive red flag. Because once again, and this is one of the most important things anyone listening should remember, the free cash flow payout ratio is 100%. That means all of their free cash is going to pay the dividend, and If it's anything over that, then it means that dividend is coming from retained earnings or it's coming from debt, which is not good long term. Can't do that for the long term. So yeah.
But are you willing to wait a bit? Like when a company hits a free cash flow of 100%, would you give it a couple of quarters to come back to a more reasonable metric number, or do you sell right away?
Yeah, it's a case by case basis. I went through this with PepsiCo. PepsiCo has been over 100% for a little while now, a couple years, because they're reinvesting. They're trying to grow the business. So they're outlaying a lot of capital to try and do that. I mean, I contacted their, investor relations just to see what they would say. They told me, well, it's kind of like, duh, I mean, but I got to give it time and I got to understand why and look at management and what they say the reason is and if they give any indication as to what the deal is with why the free cash flow has dropped and that's pushing the ratio really high. But even for big companies like PepsiCo, they can sustain that for a little while, but they're not going to do
Hmm.
that for 5 or 6 years. So
Right.
I'll be interesting. I did sell out of PepsiCo, but we actually needed money for a car. So I used it for that. And I know before people get crazy and lose their minds and say, what, you sold to buy a car? It was an overflow account. So we have money that after we've maxed out our retirement account, our Roths, after we've saved in our emergency fund, saved for travel because we love travel, kids'
Hmm.
college fund. So after all that, after we've done all that, we have money left over. So I put it in this, what I call the overflow account. And over time, it's grown. So yeah, some people got lost their minds and said, you don't ever sell stock to buy a car. I'm like, well, we need a car. Ours is a piece of junk. It's falling apart. So, we're paying ourselves back. We made a loan to ourselves from
Right.
our excess cash, but
Well, taken out of context, it may not make sense, but like you said, I mean, everything was paid for and like you paid yourself first. That's like one of the basic rules. So, I mean, I don't have any problem with that. Good for you. Congrats on the new car.
yeah, it's not new. It's a 2021 Volkswagen. I don't want to buy a new car ever. I will never buy. So that's new enough for us. It was whatever, 4 years old when we bought it. So PepsiCo, that's one that I sold out of. And that's one of the reasons I specifically targeted that one to sell is because that free cash flow payout ratio has been over 100% for a few years now.
And you've quickly mentioned dividend payout ratio. Like, do you personally use it? A lot of investors do for dividend safety purpose. So, if so, do you use like the metric itself, or do you look at history, the trend?
Yeah, of course. So if a company has a history of cutting the dividend, then there's a good probability they'll cut again in the future. But again, it's why did they cut it? I know a lot of companies cut during COVID. TJ Maxx or TJX, they own TJ Maxx. That's a company
Hmm.
that I'm very close to starting a position in. They cut it during the pandemic and they were forced by the government to close their stores. So, what are they
Hmm.
supposed to do? So, in a case like that, I give them a
Right.
pass. It was such a black swan event. And then they quickly raised the dividend to above when everything reopened before when they cut it. But yeah, I like to look at a history. And of course, past performance is not a guarantee of future results. It gives me a warm and fuzzy feeling when I see that the company hasn't cut the dividend in quite some time and they give nice payout raises.
Right. So maybe I'm gonna start a little debate here, but
Yeah.
you keep on mentioning free cash flow, and at Dividend Stocks Rock, we use what we call the dividend triangle, which is revenue, EPS, and dividend 5-year growth trend
Mhm.
as a first set of filters. So it doesn't mean that we don't look at free cash flow at all, but this is how we're gonna first look for stock. So obviously you prefer cash flow over earnings when stress testing a dividend, but why? How would you explain that?
To put it as simple as possible, earnings per share is it's an accounting entry and it can easily be manipulated. Companies can write down assets, they can shift expenses. There's one-time expenses that can affect that. Free cash flow, it's much harder to fake. It's the actual cold hard cash that a company has. And if companies do try to face it, they would risk jail time like we saw what happened with Enron. So yes,
Hmm.
everything can be manipulated to some degree, but from what I've learned, and I would love somebody to let me know if free cash flow is easier manipulated than earnings per share. So
Don't you think it is a bit more noisy though, that it fluctuate a lot more because, like you said, it's not manipulated. So maybe it could create confusion for some investors. So this is why we look at EPS first, and then if there's a red flag, we go and see free cash flow or a debt level red flag. That's the same thing. We will dig into cash flows, make sure that everything is done set. So I think maybe the important part, whether it's free cash flow or EPS, is to look at the trend, not just like a number on a stock screener. So you don't discard like quality companies too quickly, maybe, or put everything in context. Maybe that's what it's all about in the end, right?
Yeah, for sure. And I know there's other people that they only like, again, like you guys like to look at, well, maybe not only at earnings per share,
Mm,
but again, from what I've seen, there's been times where I'll see an earnings per share payout ratio of, I don't know, 120%, but then I look at the free cash payout ratio and it'll be 62%. There'll be a really
mm,
big difference. And again, that's because there can be things like a depreciation. There can, again, one time expenses. There's things that can affect in the short term. So it really does help to understand what is
right.
giving that ratio, where it's at, what's making it there. But I look at both though. I like using
Mm,
it won't hurt to see if both of them are kind of at the same levels and there's
right.
nothing crazy going on. And if one is really higher, you have to find out why. But yeah, it's
Mm.
just my opinion, and it's served me well so far.
Yeah, I don't think there's a wrong answer here. I just think that what's important is to understand what you're looking at, basically.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
And what about debt? Like you've mentioned your mistake with AT&T, which had a lot of debt. So are there leverage signals that you pay close attention to?
Yes, if the debt is rising really quickly, gotta know why the debt is rising quick. Because again, all debt has to be paid back eventually at
Hmm.
some time. And I know companies try and kick that can down the road, but one of the things that I love in people who watch the live stream that, this is a little nerdy, but the interest coverage ratio, it sounds confusing, but all it
Hmm.
is it's a number that tells us how many dollars of operating income or EBIT, earnings before interest and taxes, does a company have to cover every $1 of interest on the debt? Because that's so critical. Companies
Hmm.
have to be able to pay the interest on the debt. The interest coverage ratio is a fantastic number. So if a company has an interest coverage ratio of say eight times, well, that's $8 of operating income to cover every $1 pretty easily of interest on the debt. But if a company's at 1 or 2, then they are cutting it razor close, because anything could affect what that earnings before interest and taxes, if that drops suddenly for a year or two and they suddenly can't pay the interest on the debt, then the dividend's most likely going to get cut, because
Hmm.
they are legally required to pay that interest on the debt, and the
Right.
company, the health, the life of the company would be in jeopardy at that point. So for me, that's a fun metric to look at, and I'm sure there's YouTube videos explaining the interest coverage ratio, but that's one of the main ones. And like I said, all debt has to be paid back. And again, Peter Lynch, one of my favorite people to read, he's the one that said that if a company's debt free, bankruptcy is a near impossibility, and it would take a
Right.
really talented, very talented management team to do that, to go bankrupt with no debt.
Right. Actually, I didn't know about this metric, so I'm very interested. I'm gonna have a look at that for sure, especially with like capital intensive businesses, right? That could be very interesting to look at.
And it doesn't
Um,
apply to all, because I just want to say there are some
right.
companies like banks where their whole, yeah, so it's not a be all end all, but for a lot of most companies, the interest coverage ratio is a very helpful metric to look at when looking at their debt and if they can pay it.
So, Russ, could you walk us through an example of a stock you avoided buying because the safety signals weren't there?
Yeah, so Dickies. I wear Dickies pants. Like I've always worn them since high school. And there's a company called VF Corp, ticker VFC, that owns the Dickies brand. And
Vans.
I and Vans and Timberland and a few
Yeah.
others that escape me. But yeah, so I wanted to buy the company because I wanted to own the company that owns Dickies, because I wanted to eat my own cooking, I guess. But when I looked at them, they were on the verge of becoming a dividend king, but their free cash flow ratio was 139% in 2020. And then it dropped to 73%, which was still a little high, but okay, that's
Mhm.
doable. Then in 2023, it rose to 144%, which again was a massive red flag. And I just because of that, I stayed away. I didn't buy it. They raised their dividend for the 50th year, made them a dividend king. And then right away, I noticed their free cash flow dropped to negative 78% because their free cash flow went negative, and then they cut the
Mhm.
dividend right away. So they raised the dividend. They were called a dividend king, and then a quarter later or so, they cut the dividend.
Right.
So 50 years of dividend raises down the drain. Maybe a side note, that's why people love talking about dividend aristocrats, dividend kings. Any company can cut the dividend. It's written in pencil, it's not written in stone. The dividend is
Mm.
always negotiable, it's always on the table. So people have to remember that if a company has raised it for 80 years, it can be cut if the
Right.
company needs to. So yeah, so that was one that I stayed away from. They just, again, I saw their sales were falling, their debt was rising, the interest coverage ratio was dropping a lot, and all of their margins were compressing. So I stayed away, and luckily so, because it's been beaten down. Stock price hasn't really come back.
Recently a GSR member told us that we're basically yield agnostic, which is an expression that I really like because I think it illustrates perfectly how we see things. What is your view on that? Like, do you aim for a specific yield range in your portfolio or you don't care at all?
I used to, and that was really dumb. Boy, was that dumb. I missed a lot of great companies because they didn't pay a 2.5% dividend yield. I don't even remember why I landed on that number, but for a period there, a couple years, if it didn't have a 2.5% starting yield, it was too low for me, and I wouldn't even look at the company. So I missed
Right.
a lot of companies like Costco. Boy, I wish I could go back in time and buy Costco, but yeah, so that was one of the things I used to do, but I've evolved. I'm sure you can hear it in my voice. The main point is that I have many investing years ahead of me. I'm 47, so I have a lot of years ahead of me, and those yields, they'll grow. If it's small and they grow the dividend very quickly, and I'm sure Mike, I know he talks about it, over 10
Right.
years, over 20 years, you'll get a 8, 9, 10% yield on some just wonderful, wonderful companies. And at one point, that starting yield may have been 1% or a little bit less, 0.75%, whatever it was. So I guess you have to look at it is, do you want a smaller starting yield with lots of growth, or one that has a higher yield but is a low growing? And that's what I used to lean toward. I think that's great for people that are in retirement, that are preserving their wealth and are living off dividends right now. But honestly, I mean, companies that pay a lot of their money out are toward the lower growth end of their life cycle. They're not
Right.
reinvesting and plowing that money back into the business to keep it growing. So
Mm.
two of the companies that I've gone into, over the last couple years are Zoetis and Visa. So Zoetis has a 10-year dividend growth of 20%, and Visa's at 17%, which they consistently do that over many, many years. That
Mm.
is a very nice yield. And the stock price goes up too a lot because the company is growing. So the profits pull the company's stock price higher over time.
You've mentioned like age and retirement a bit. So many investors say it's different as we age. Like, do you agree with that? Should someone close to retirement aim for high yield? Should they change their portfolios? What should they do in your point of view?
So obviously, like I said, I'm 47. I'm not retired yet. Will be someday, I hope. But talking with community members that are retired, a lot of them have told me that, and these are people that are living off their dividends, they like a sustainable, not necessarily really high, but if they can find a 4% yield that is sustainable and the company grows a little bit, they're totally fine with it and they like that. So I guess, but it's different for everybody. It depends on how much money
Hmm.
you want to spend in retirement. But
But what
again,
about selling shares at retirement? Like,
yeah,
what's the problem with that? I think this is a good way to do it. Not the only way, but it's another good way to see that. Like you can sell some shares and still have like a big enough portfolio for your retirement, right?
that's why I love when Mike did that example when he did the I think it was just S&P 500 and then one of the covered call funds. And Warren Buffett has talked about this too. He's showed that if you buy a company that grows a lot and is plowing all or most of its money back into the business to keep the business growing, that if you take out of that the amount that you would have received in whatever dividend, whatever, say you want 5%. So you take 5% a year out of that company that you invested in or the ETF, whatever it may be, then you will end up with more money. You will still have had that money. You decide what you want and when. You don't have to pay tax. I know I'm hearing this and I'm like, so why should we buy dividend stocks again? But right, defeating my own argument as I'm talking. But again, and this is something everyone should have to decide for themselves. But yeah, you will have more money in a lot of these scenarios because the companies or the funds are growing a lot faster than the company paying high dividends because they're toward the lower end or toward the end of their growth life cycle, or I don't know how to say that, where they're growing, whatever. They're not growing as fast as they used to. And there you go. So the stock price isn't going to grow as fast as companies that are growing a lot. But still, I still like the individual companies. And I don't know. So that's where I'm at now, looking at companies that have fast dividend growth, companies that are still growing pretty quickly. And I guess I'll end that thought with Charlie Munger used to say that if you buy a company that has a 6% return on capital over 20 years, you're going to get about a 6% return. But if the company has a 20% or high teens return on capital, doesn't matter when or where you buy the stock, over those 20 years, you're going to do very well.
Right. So if someone listening is nervous about dividend safety right now, where should they start?
I would think an ETF. You have to start somewhere. You have to learn. If you're too nervous about picking an individual company, there's really good options out there, especially for ETFs that focus on dividends. Something like the SCHD, which is the Schwab US Equity Dividend ETF, SCHD. There's the Vanguard Dividend Appreciation ETF, ticker VIG, that one. And these aren't recommendations, these are just ideas out there. So VIG focuses on, like it says, the dividend that's growing, or the iShares Dividend Growth ETF, ticker DGRO. Those are great places to look. You can look under the hood at the top holdings of those, see what companies are included in there. And then maybe you can start looking at those individual companies. But here's the thing that I've learned. ETFs teach you nothing about investing, nothing. And that's fine. My wife, I try and get her, and my daughters, I've tried, and I'm hoping one day it'll, the light switch will flip on, but it hasn't happened. So my wife is just in VTI in her retirement account because that's almost 3,000 some companies. So it's buying a lot of companies. And yes, you're buying a lot of the Mag 7, but that's, for better or worse, it's been for better. But when you buy an ETF, you learn nothing about investing. And again, that can be perfectly fine. But if you want to learn about investing and buying companies, because when we buy a stock, that's, again, you are buying an actual piece of a business, which I think is just, it's the coolest thing. It is the coolest thing that if you wanted to, I can just buy a piece of Costco and own part of the company. Granted, it's a little, you need a microscope to see the size of the company you own, but you learn, you can develop your own conviction in the company, because if you don't have that conviction and the stock should drop 20%, you probably won't know what to do and you might sell instead of buying more. So that's what I would say. If you're nervous, just the easy button is an ETF, and then look at the ETF you bought and understand what's under the hood and the top holdings that are in it. And you can get some ideas, fantastic ideas in there.
Right. I just love how you put it. ETFs are great. I mean, you're going to reach your goals with ETF, but they're not teaching you anything. And actually, when I first started, I bought an ETF, and it got me more nervous than individual stocks because I didn't understand what was going on. So I guess it's a case by case scenario. People have to try it to know, but it is a good option for sure. I like how you put it. I really love it.
I'll add one
Yes,
thing. Peter Lynch says to know what you own and why you own it. And I guess that goes for an ETF. My wife can tell you what VTI is. She may not know anything else, but I told her, I'm like, you understand what this is? She understands it's, you're buying a sliver of 3,000 some businesses, the US stock, almost the whole US stock market. And over time, those businesses are going to keep growing, and it's self-cleansing. as companies do well, they're going to rise toward the top and keep pushing it higher. And the companies that go out of business, like Blockbuster Video, they'll eventually fall away and be removed. And you don't have to do a darn thing. You just
Right.
keep buying that one ticker symbol. And I'll end this thought with that. There's been times I've spent weeks and weeks learning about a company, and this is going back, when I first started. Thought I was really smart buying a company, and then I'll compare it years later to just say VOO, the S&P 500, and with dividends reinvested, it did much worse. So I could have just bought the boring thing, like Warren said. People don't want to get rich slowly, and could have had a lot more money. But hey, I learned something, I guess. So that's got to be worth
Right.
something.
Okay, so where can people follow your work or learn more about you, Russ?
DapperDividends.com is the website, and YouTube. Just type in Dapper Dividends or Russ Knopf, and I'll come up somewhere. You'll see me.
Well, thank you so much, Russ. I hope that you had fun because I really did. It was such an interesting discussion. I'll remember a lot of it.
Thank you, Vero.
You're welcome. Listeners, to create sustainable dividend income, I invite you to download our free Dividend Income for Life guide at thedividendguideblog.com/income. Remember to follow Russ on YouTube at Dapper Dividends. I will also put the link in our show notes at thedividendguideblog.com/260. This was a perfect last episode of 2025, but we also start the new year strong tomorrow with a special mini series on how to invest in 2026. So hit pause now and click the subscribe button underneath our logo so you don't miss it. And until tomorrow, stay invested.
Disclaimer: the following is for education and general information only, not investment, legal, or tax advice, and not a recommendation to buy or sell anything. Investing involves risk, dividends are not guaranteed, and past performance does not predict the future. I may hold position in securities discussed and may trade at any time.